Okay, in this note, they show you the statement of cash flow for indirect method. Okay, most of the company will use indirect method in order for them to prepare the final statement of cash flows. Okay, so the first one, you should have the net income. Okay, net income from the statement of profit and loss. Okay, and then if there is an account receivable, you should compare the accounts receivable with the current years and the last year. Okay. And the questions given, and then they will give the information, okay, regarding the amount of the financial statement the last year and this current year, so that you can compare the account receivable. If there is increase in account receivable, you must less. Okay. And then if there is an increase in inventory, you must less. Okay, then goes to prepaid insurance. These three things is current asset. Okay, you must remember that I taught you last on Monday, right? Okay. So increase, how about increase in account payable? Account payable is our current liability. Okay, current liabilities. You must compare the amount for 2006 and also, for example, 2005, and then when you see the statement of profit and loss, where there is an increase, you should add on, right? If there is decrease, you should less. Same goes to account receivable, inventory, and prepaid insurance. That is the current asset. If there is a decrease of the amount between 2006 and 2005, so you should add on. Alright. So then after that, 385 you should less with 9, 22,000, less with 1,000, and then add on with 3,000. Then you will go to the total for cash flows from operation is 19,615. Okay, this is indirect method. And then proceed and continue with the cash flow from investing activities. Okay, you must remember the investing activities is including, okay, the cash that you use to buy or to purchase of your non-current asset. Okay, non-current asset. For example, purchase of truck. Okay, because of the cash is outflow, so that you must less. Okay, you must deduct. Okay, 19,615 you must deduct with 8,000. And then also, if the company has to purchase of building, so also deduct from the investing activities. Okay, purchase of land, also deduct 10,000. And then we will get the total cash flow from investing activities is 43. Alright. So how you got 43? 8,000 add on with 25,000, add on with 10,000, so you have minus negative 43,000. Okay, the total is negative 43,000. Then from the total cash flows, oh my god. Why you get negative here? Because of the cash is we call it as negative flows. Alright, cash flow is in negative, so that you should put the column here. Alright. Because of 10,003 and 85, you minus with 923. So minus with the bigger amount from the positive net income. So that's why the total cash from operation is in negative amount or value. Alright? So that's why the negative value is in the column. You should put column there. Bracket or what is this called? Something like that. Okay. So, and then same goes to the total cash flows from investing activities. Okay, also negative amount or value. Okay, next, you continue with the cash flow from financing activities. Now you must remember, financing activities we got from the statement of financial position. Okay, about the borrowing for the mortgage or loan from financial institution. Okay, we got the money from there, and then okay 20,000. Okay, and then we plus with the honest investment. Okay, invest by the shareholders. Okay, 60,000. So total is 80,000. The total cash flow from financing is 80,000, and then so you can get the net increase in cash and cash equivalent 17,385. Okay, if there is no balance, okay, notice that this is the same number for ending cash on the balance sheet. Since there is no beginning balance, 0. Okay, so if there is a balance, beginning balance, you must add on with the change with the net increase in cash and cash equivalents, that is 17,385. Okay, that is the answer. How come you get the 17,385? Okay, you start from the operating, so you have 19,615 minus 19,615 minus again with 43,000 and then plus with 80,000. Okay, so that you will get okay 17,385. Alright, 17,385. Okay, that is the format for the net and statement of cash flows for indirect method. Okay. So then there is if you look at the notes that I showed you, okay, and then later on I will give these notes inside the WhatsApp group so that you can further reading, continue further reading about the financial, the statement of cash flow, right? Okay, so let's continue with the direct method. Okay, there is a difference between the direct method and indirect method when in the operating activities. Okay, determine the net cash provided or used by operating activities. Using, okay, we can determine the buying and selling goods. The step involves analyzing not only the current year statement of earnings, but also comparative balance sheet and also selected additional data. So that's why when you uh, look at the question, okay, they also give you the information, okay, regarding the balance sheet or statement of financial position, okay, so that you can compare the balance. Alright, so this the cash receipt and cash payment. Okay, direct method using the cash receipt and also cash payment. Okay, you must identify how much is the cash receipt and cash payment. Okay, what is the cash receipt? Okay, received by the company. Cash received by the company from the sales of goods and services to the customer. If the company um, sold the product, so that's why the sale is come from the selling of the goods. Okay, if the company is rendering the service to the customer, for example consultation, okay, for example clinic, okay, and then law firm, okay, so the sales of the service is the cash receipt from the customers. Okay, and then what else is the a receipt from the interest that that the company receive, and also dividends on loan and investment. Okay, that is the two types of receipt. All right, the cash receipt by two activities here, that sales and also interest dividends, interest received, dividend received, and on the investment. Okay, so that you must minus, okay, cash receipt, you must minus with the cash payment. Okay, cash payment by the company to the outsiders. Okay, who is the outsiders? Also, uh, okay, the outsiders is the parties or users outside the company. So, for example, suppliers. Okay, cash paid to the suppliers. Okay, suppliers is the persons that sold to you the goods. All right. And then number two is employees. Okay, so in the company they must uh okay, they must have an employees. Okay, so the employees, the company should pay the employees salaries, right? So yeah, the employees. All right, then the third one is for operating expenses. Okay, how you want to deliver the goods that buy from to deliver the goods to the customer. So, for example, you have the delivery expenses. So it is included in the operating expenses. Okay, the fourth one, interest. Okay, instead of interest you receive, okay, you receive the interest. So interest also you must pay. Okay, the company must pay for interest if there is liability, for example, loan. Okay, long-term loan from the bank. Okay, instead of we must pay the principal. Okay, we should also pay the interest. So that's why interest is one of the expenses paid by the company. And then number fifth is for taxes. Okay, taxes is two kinds. The company pay the taxes to for the government. Okay, and then so the government will use the money from their citizens, okay, to invest in the facilities, okay, the facilities, and also for welfare of their citizens also, right? So that is the taxes. So that after you minus cash received with the cash payment, so you will arrive at the net cash provided by operating activities. Alright, the net cash provided by operating activities. Okay, that is the direct method. Okay. So what is the relationship among the cash received from customers, revenues from sales, changes in account receivable, okay, revenues from sales, okay, is equal. Okay, this is cash received from customer is using direct method. If you notice, okay, the difference between these two methods is at the operating activities. Okay. So cash received from customer is equal to revenues from sales, where you must add on where there is a decrease in account receivable or increase in minus when there is an increase in account receivable. Okay. This is using indirect method. Okay, so you will arrive at the same amount here. Okay, even though okay, the formula, the format or the formula, okay, in order for you to get the amount is different, right? So cash payment to supplier, relationship among the cash payment to supplier, cost of goods sold, changes in inventory and changes in account liabilities. Okay. So all the cash payment to supplier, okay, direct method, also the same. If you arrive at the cost of goods sold, there is increase in inventory, you must add on, or whether the decrease in inventory, you must minus. And then when there is a decrease in account payable, you must add on, and then increase in account receivable, you must minus. Okay, so there is the same thing, but different formula. Okay, this is for direct method, cash payment, and then the blue one is for the indirect method that we taught before this. Okay, then cash payment for operating expenses, the relationship among the cash payment for operating expenses, changes in prepaid expenses, changes in accrued payable is cash payment for services is equal to the operating expenses, increase in prepaid expenses or decrease, and then decrease in accrued expenses or increase in accrued expenses. So that is all the relationship between the two formulas. That is direct and also indirect. Okay, same goes to the cash payment for taxes. Okay. Okay, so this is the direct method sample format. Okay, for operating expenses. So you have the title here. Okay, statement of cash flow, direct method. Okay, you must notify there. Okay, you must state which method that you use in order for you to prepare for the statement of cash flow. Okay. Joshua. Sorry, madam, saya sekarang keluar dengan nenek saya. Joshua. Okay, so what is the cash flows from operating activities? Okay, you got from the cash received from customer. Okay, part 17. And you must be less or minus with the cash payment. Okay, cash payment for operating expenses 2210. For income, okay, cash paid for income taxes 89. So that 517 minus this 299, you will get the net cash provided by operating activities is 218. Okay, 218,000. Is that clear? The direct method format. Okay. So then proceed with the investing and financing activities. Okay. For the direct method or indirect method. So when you prepare for the investing and financing activities, okay, the format is the same. Alright. There is no difference between direct method and indirect method. Okay, so here they have the money, okay, okay, and then the money they use, okay, the company used to invest, okay, to buy or to purchase assets. Okay, the steps involve analyzing comparative data and selected additional information for their effects on cash. Okay. So, if in investing activities, okay, it studies the balance sheet, okay, to determine changes in investment and also long-term asset. Long-term asset is other term of non-current asset. Okay. Okay, you must understand what is non-current asset or current asset. Okay, there is a difference. So if there is a changes in your investment and long-term asset, the changes in each short-term investment, unless incorporated as a part of cash definition, and long-term accounts are analyzed using selected transaction data to determine the effect, if any effect the changes have on cash. Okay. So for the financing activities also, we study and we calculate the difference, okay, the changes of the non-current liabilities and shareholders' equity. Okay, so from the balance sheet statement, okay, other name for balance sheet, you must know statement of financial position. Okay, so when there is a difference, okay, between, okay, the liabilities, non-current liability, and also shareholders equity, so you should put in the financing activity. Finance means that from where that you got the cash itself, okay, the money for you to operate the business. Okay. From where? First from the loan, okay, loan from the bank. And another one is the capital, okay, shareholders, okay, money that give by the shareholders, okay. That is the sources where the company will get their money to finance their company. Okay, so this is the continue with the, okay, at the top we discussed about how can we derive to the operating activities 218,000, right? So then let's continue. Okay, you must add on with the cash flows from investing activities. Okay, so the format must be in horizontal. Alright, so secara ke bawah, horizontal. The list for the format is horizontal. Horizontal format. Okay, so cash flow from investing is the question give you, okay, that the company have to purchase of buildings, okay, purchase of building, purchase of equipment, okay, you must minus, okay, because of the our money is go outside, okay, go outside from the company, okay, our money to purchase of the building. So that we must put negative here. Okay, negative means that the money is outside, go outside from the company. It means that we must pay for the building, we must pay for the equipment. Okay. How about sale of equipment? If there is a sale of equipment, it means that there is some equipment or there is some assets that the company will no longer use that equipment. So that the company is take an action to sell their equipment so that the company will get the money from the sale of the equipment, 4,000. So you look here is the positive amount. So and then okay, 160 minus with 25 you will get, and then add on with 4,000 you just get the negative 181. Okay? Negative 1 is 1,181 thousand. Did you understand how to calculate this? No. Yeah. Okay, did you know how to calculate this? Until you will get this 181, 160 minus 25. Okay, you use your calculator to calculate. Alright? So you must put, you should have scientific calculator. Did you have the scientific calculator with you? Or you just using the ordinary calculator? Which calculator that you have? Ratio. Alright, very good. Ratio is scientific or not? Yes, okay. So then you will understand how to calculate this, alright? So negative 160,000 and minus with 25,000 and plus with 4,000, you will get 1,081,000. Okay? So after that, we should put the cash flows from financing activities. Okay? So what we have inside this example is only the 7 payment of cash dividend. Okay? The payment of cash dividend. Okay? Only one, right? Only one here. But if you see another example here, okay, it can be, okay, look here. It can be honest investment, okay, going for the mortgage. Okay. It depends on the question or depends on the balance sheet of the question. Alright. So then the net cash used by the financing activities you must minus, okay, so that you will get, okay, 218,000 you minus with 181 and minus with 15,000. So then you have the net increase, okay, because of the amount is positive here, so that increase in cash. And then if there is an balance, okay, opening balance in the question, so you should add on. So you will get, okay, 22,000 times 22,000 and only the 34,000, and then you will get the cash at the end of the period is 56,000. Okay? So that is the format for direct method. Okay. So if you see, if you can compare the format for direct and indirect, so direct is more easier if compared to indirect. But then indirect is the most popular method used by the company, right? So let's look what is the purpose. Okay, what is the using of cash flows to evaluate companies? Okay, or so in the cash flow statement, so we will know the liquidity of the company. Okay, liquidity means in Malay we call it as kecairan. So what is the liquidity? It means that the company has enough money, so has enough cash in hand in order for the company to pay their obligation. So that is the liquidity. Okay. So cash current debt coverage ratio. Okay, we will analyze again the liquidity of the company using cash current debt coverage. Okay, ratio. So we analyze using the ratio. Okay, then the formula. Okay, you should know the formula to calculate for the cash current debt coverage ratio in order for you to determine the liquidity of the company. And if you want to compare, okay, if you want to compare our company with other company, our rivals or our uh, outside the company, so that we must use the liquidity, we must check for the liquidity of the company using the current debt coverage ratio. So the first one is liquidity again, and then the second one is solvency. Okay, solvency means that uh, there is there is enough money to use for operating the business. Okay, free cash flow. Okay, capital expenditure ratio. Okay, we will see the ratio of the solvency again that we can check of the company using the cash flow and then cash total debt coverage ratio. So what else? The third one is the profitability ratio. A profitability, okay, how much that the company earn, okay, from the sales of the product. Okay, that is the profitability. Okay, how much can the business or the company can generate income from the selling of the product. Okay, so by using the ratio, what ratio? Cash return on sales. Okay, from the sales, so that's why I mentioned before this. Okay, how much is your return? Okay, on the sale. How much you will get from the sale? Okay, how much cash that you will get from the sale? Okay, that is the cash return on sales ratio. Okay. All the ratio are cash based instead of accrual based. Okay. So all the ratio here, okay, use the term cash. Okay, cash, current debt coverage ratio, cash, free cash flow, okay, cash, total debt coverage ratio, profitability using cash, return on sales ratio. All this ratio is using the cash base. Okay, because cash flow statement, right? So you determine the cash only, okay, not the accrual base. Okay, accrual it means that when we did not get and the money or we did not pay for the expenses. Okay, so we must record. So that is the accrual based. We must record where? We must record in the financial statement. Okay. There is a difference, okay, between the financial statement. You must remember. Okay. We prepare financial statement, that is balance sheet and also profit and loss using accrual base, right? For statement of cash flow is using, okay, we prepare the statement of cash flow using cash based. So that you must understand two things, okay, in the accounting. Okay. So let's look at what is the cash-based measure? Okay, the first one, accrual-based measure allow management discretion, but for the cash-based measure the cash-based measure has no readily available published industry average for comparison. Okay, so how can we calculate the cash current debt coverage ratio? Okay, since the cash from operating activities involves the entire year rather than a balance at one point in time, the cash current debt coverage ratio is a better representation, okay, of liquidity than the current ratio. Okay. Later on, okay, we will discuss more further about the current ratio. Okay. So the current ratio is actually we will cover this topic, if I'm not mistaken, is in topic 7 or 8. Okay, how we can analyze for the financial statement. Okay, we analyze using current ratio. Okay, so they said here to to search for the better liquidity. Okay, the better liquidity is using, okay, to know the liquidity of the company better, you use the cash current debt coverage ratio rather than current ratio. Okay, so let's look at what is the formula. In order to calculate the cash current debt coverage ratio is equal to cash provided by operating activities, okay, and then divided with average current liability. That is the format. Okay. So how we can calculate the free cash flow? The free cash flow is the cash provided by operating activities minus with the capital expenditure and also minus with dividends. Okay. So that you will get the free cash flow. Okay. That is the formula. And then let's look at the capital expenditure ratio. Okay, what is the capital expenditure ratio? It is an indicator of the company's ability to generate sufficient cash to finance new capital assets. Okay, new capital asset is what is a capital expenditure? Is actually when we use the money, okay, when we pay the amount of money in order for you to get the assets. Okay, asset that is non-current asset, so that is the capital expenditure. Okay, capital expenditure. Okay, the asset can be used for the long term period, so that's why we classify that expense, okay, under capital expenditure. Okay, so how to calculate the capital expenditure ratio? is equal to cash provided by the operating activities divided with the capital expenditure. Okay, so how about cash total debt ratio, debt coverage ratio? Okay, cash total debt coverage ratio is a measure of a company's ability to repay its liability from cash generated from operating activities. So that cash total debt ratio coverage ratio is to determine whether the company has enough cash in order for the company to pay their liabilities or debts, okay, or obligation. Okay. So how to calculate the ratio is cash provided by operating activities. Okay, we must divide with the average total liabilities. Alright. So how about the cash return on sales ratio? Okay. Cash return on sales ratio is indicates the ability to turn sales into cash. So the formula is the cash provided by operating activities divided with net sales. Okay. This is all the ratio that we can calculate. Okay, if we have the financials, if we have the statement of cash flow. Okay, so that inside the statement of cash flow there is the cash. Okay, we can identify the amount of the cash provided by operating activities, right? Okay, so that's why we can use that cash flow in order to calculate for the cash return on sales and then divided with the net sales. Okay. From where can we get the net sales is from the balance sheet. Okay. So the information that we can use inside the balance sheet. Okay. Alright. There is a last chapter. Okay. Last topic. Last subtopic here. Okay, so look at the decision checkpoints. Okay, inside the statement of cash flow, we can know how much cash did the company generate to either expand operation or pay dividends. Okay, you have an option. After the company prepare the statement of cash flows so that the management will decide, alright, whether to expand, whether the management want to use the money to expand the operations or whether to pay the dividends. Okay, dividends we must pay to the shareholders if there is and if the company has an excess of the earnings, okay, or the net profit is bigger, okay, is higher than expenses, so that we have an excess of money, so that the money we should pay the dividends for the shareholders. Okay. So from the statement of cash flow, you can decide whether you want to expand the operation or you want to pay the dividends of the company of the shareholders. Okay. And then can the company finance its capital expenditure with the cash provided by operating activities? Is that enough for the companies to use the cash to expand, okay, to finance in the capital expenditure? Okay. What is the capital expenditure? I said to you before this, you use the cash or you use the money to purchase, okay, non-current asset, okay, long-term asset. Okay, for example, machineries, okay, equipment, okay, that is all the capital expenditure. Okay, we use the money, and then we can use the asset, okay, throughout the years, okay, more than 1 year. Okay, so the asset can benefit the company more than 1 year. So that is the capital expenditure. Okay, so that you can know how much is the free cash flow of the business, okay, and then the ratio of the capital expenditure. And then we can look at, is the company generating sufficient cash provided, okay, by operating activities to meet its current obligations. Okay, so is the company generating sufficient cash provided by operating activities to meet its long-term obligations? Okay, there is all the same things that I've mentioned before. Okay, are differences between cash and accrual accounting receivable. Okay? So last slide. Okay, what is the summary of the chapter 5? Okay, actually you should have, okay, you should be able, okay, to indicate the primary purpose of the statement of the cash flow, and then distinguish among operating, investing, and financing activities. And then explain the impact of the product life cycle on a company's cash flow. Okay, you can remember there have 4 product life cycle, 4 phases. Okay, introductory, and then growing, matured, and also decline. That is the 4 product life cycle. So what is the relationship between the product life cycle and also cash flows of the company? Okay, and then we already discussed how to prepare a statement of cash flows using one of 2 approaches, the indirect and direct method. And then last, we use the statement of cash flow to evaluate a company using the ratio. Okay? So, complete our chapter 5, chapter 4 actually, right? So in our syllabus is in chapter 4. Okay, did you have any question regarding this chapter? Michelle? No. Okay, so I will find you the question, okay, about the question about the cash flow statement. Okay, and then after I found out, and I will share to you, and then so that we will discuss together. Alright? So in the meantime, I want to proceed with the chapter. Okay, what chapter after this? Chapter 5. Okay. We have overall about 13. Wait, I can't remember how much is our topic. Okay, you can look at our course outline. How much topic is covered under LCD 102? Hmm. And then, okay, for the quiz, okay, we have, okay, wait for a while. I just want to see for our course outline first. Okay, we have for this semester, what is the assessment? Okay, we have for 13 chapters overall. Okay, So for the continuous assessment, we have uh, quizzes, okay, 20%, and then assignment 20%. Okay, and then I will decide which topic that we cover under the assignment. And then the third one, we have the midterm 20%. Okay. And then for the final exam is 40%. We have 13 chapters overall. Okay. So quiz is 20%. And then assignment is 20%. Then we have a midterm. Same with our uh, assessment on acd101. If you notice, final exam is 40%. Okay, so total is 100%. Okay, and then later on I will decide which one we will cover for the assignment. Okay? So, is there any question regarding the assessment? Alright. So after this, okay, the chapter 5 is analyzing financial statement. Okay. So if you remember what I said before this, okay, instead of we have the ratio, okay, by analyzing the statement of cash flow, we also have the analyze for the financial statement. Okay. So wait for a minute. I want to open the notes first and then convert to the PDF. So this is the slide. Okay, the chapter 5 is about uh, analyze of the financial statement analysis. Okay, using the ratio. Okay, so the objective is to know about the financial statement. Okay, you already know the financial statement. Oh my god. Okay, and then so financial statement we have two things, that is balance sheet and also statement of profit and loss. Okay, profit and loss. That is the financial statement. Okay, then understand the company position based on the financial statement by using the ratio analysis. Okay, how can we know the company's efficiency? Okay, the company performance using the ratio analysis. Okay, so nature of the financial statement. Sorry guys, I am nervous right now because I got the message from the my suggestor regarding the vaccination. Both of you already vaccine or not? You already complete for the booster? Is there any impact for the booster? Okay, you the for the fever. Oh my god. Saya takut. Untuk first dose, second dose tu, uh, you ambil yang mana? Which vaccine? Oh, aduh, dua Pfizer. Same with me. I also taking Pfizer. My God, I am the worst. Okay, which area that you got your booster? Oh, clinic in Sumbar. I got clinic from Senawang Jaya. My goodness. 29 on 29. Another 4 years. 4 days. My God. Macam mana ni? Tak nak pergi boleh tak? Oh, mampus lah. Aduh, ya. Saya takut lah. I heard many side effects for the booster. Wah, very good of you lah. Mesti you punya immune system is very good. Kuat immune system. Okay, never mind. Let's continue with our okay, what is the nature of the financial statement? Okay, financial statement is actually recorded the facts, okay, because of all the things or the elements or the value inside the financial statement is the facts, okay, the amount that we have an evidence, okay, regarding the value. For example, if the value of the sale, for example, we have the sales amounted to 100,000. So before the accountant put the amount inside the financial statement, they should have the evidence in terms of source document. Okay, source document. So that's why all the financial statement inside is recorded for the facts. And then there is also accounting concept, convention, and principle. Okay, when we prepare the financial statement, we should know the concept, okay, and then the conventions and principles. That is also international principle, okay, regarding the accounting. Okay, everybody everybody in this world, especially for the business company, use the same concept, convention, and principle. Okay, so the third one is the personal judgment. So that is the nature of the financial statement. So what is the essential qualities of financial statement? Our financial statement should have relevance, okay, understandability, reliability and accuracy, comparability, and also time completeness and timeliness. Okay, this is the qualities. Also, this is the standard actually. Okay, the standard say that our financial statement should be relevant. Okay, and then understand by all the laymen especially, and then reliable and accurate, and also can be compared within our company throughout the years or outside the industry, and it's also completeness and timeliness. Okay, there is the timeliness. Okay, financial statement we prepare on the uh, accounting period. Okay, so if each of the company will have their own accounting period. Okay, so that at the end of the accounting period, so that the company should prepare for the financial statement and then should publish in their website to the public, and also submit to the uh, Suruhanjaya Syarikat Malaysia, we call it as CCM. Okay, it's an obligation for all of the business, okay, to submit for the financial statement to the CCM. Okay. Companies commission companies, I can't remember what it stands for, but in Malay we call it as Suruhanjaya Syarikat Malaysia. Okay, but there is also the financial statement also have a limitation on it. Okay, for example, lack of precision, okay, lack of exactness, incomplete information, interim reports, okay, something like that. The historical cost, because we record all the value that already passed, okay, not the current value. Okay, that is the limitation of the financial statement. So how we can analyze, okay, the financial statement. Okay, financial statement analysis means the analysis, comparison, and interpretation of the financial data to achieve the desired result. What is the tools? Okay, this is all the tools to compare and, okay, the tools to analyze the financial statement, comparative statements. Okay, you can compare between two different company, alright. So which one is better? Okay, whether the company A or company B. That is the comparative statement. Second, we can also analyze and compare within the common size statements. Okay, for example, if you want to compare manufacturing companies, okay, you choose two manufacturing companies and then you compare by using analyze of the financial statement ratio, okay, using the ratio. And then the trend analysis, ratio analysis, okay, fund flow statement and cash flow statement. Okay, so cash flow statement we already mentioned before, that's right, in the chapter 4. So we will look at ratio analysis actually. Okay. So interpretation, the analysis is of no use without the interpretation. The company has to interpret the financial statement which it has analyzed. Okay, the analysis is made to serve the following purpose. Okay, so we analyze to the financial statement and then we look into the three area. Okay, the profitability of the company, the liquidity of the company, and the solvency. Okay, solvency of the company. Solvency is the financial structure. Okay, the interested parties in analysis of financial statement. There is the interested parties. Who is the users of the financial analysis, okay, financial statement analysis. Management, of course, the management itself in the business, in the company, okay, the management itself need to know their performance, okay, using the financial statement analysis. Okay, investor, the parties outside the company, they have more money, okay, where they want to put the money, whether to choose the company A with the company B, which one is better, so that using the analysis, okay, of financial statement. Bank and financial institution, of course, they want to know the financial, okay, the solvency of the companies. If the company want to make a loan with the bank, okay, the bank should know, okay, the status of the company itself, okay, whether the company can pay back their loan or not, okay, whether the company will meet the obligations to pay the interest and principals every month or not, okay. So trade creditors also, government and the agency. Government will know, must know the financial statement of each of the company in order for them to make a policy, okay, make a policy, and then to calculate for the percentage of the taxes that that company should pay to the government, okay, in terms of taxes, cukai. Okay, and then employees also want to know whether their employer is better in the financial or not, okay, whether they can the company will sustain or akan bertahan lama ke tidak. So employees perlu tahu perkara tersebut, right? So same goes to the customers, public and trade association and also stock exchange. Okay, so let's look at the financial analysis. Okay, so this is an introduction. Okay, financial analysis is the process of selecting, evaluate, and interpret the financial data along with other pertinent information in order to formulate an assessment of a company's present and future financial condition and performance. Okay. So we have, okay, financial ratio analysis you have classified into 4 types. Here the first one is activity ratios. The second one is liquidity ratio, and then the third one is solvency. The fourth one is profitability ratio. Okay, what is activities ratios? Activity ratios is effective in putting its asset investment to use. Okay, for the liquidity ratio, we will look at the abilities of the company to meet the short-term immediate obligation. Okay. Then, okay, solvency, whether the company is have the ability to satisfy that obligation. Okay. Liquidity ratio is more to the short term, means that whether we have a short term loan, whether we can pay back the short term loan or not. And then for solvency, in a long term, okay, long term debt. And then profitability ratio. We will look at the ability of the company to manage the expenses to produce profits from sales. Alright? So there is a 4 ratio here. Okay. So activity ratio. Okay. Turnover ratio reflect the number of times asset flow into and out of the company during the period. The turnover is the gauge of the efficiency of putting assets to work. Okay. So there have how many ratio that we can calculate under the activity ratio. The first one is inventory turnover. Okay, how to calculate inventory turnover? Okay, you must have the information of the cost of goods sold. COGS. Okay, all these things you can find out in the financial statement. Okay, that is the balance sheet and also profit and loss. if you can remember how to calculate for the balance sheet. And again, if you remember what is the format of balance sheet and also statement of profit and loss. Okay, but then in order to answer this question, you just need the information given. Okay, in the question, the information is given. Okay, in terms of the financial statement. Okay, and then you just pick up the amount and then you put here. Okay, so then you will get the inventory turnover. Okay, cost of goods sold divided with the average inventory. So how to calculate for the average inventory is inventory, opening balance inventory plus with the closing balance inventory divided by 2. Okay, so that you will calculate the amount of average inventory. Okay, so inventory turnover is uh, okay. How can we interpret inventory turnover? So how many times that inventory is created and sold during the period? Okay, how many times of the company to restock their product and then sold to the customer. Restock from the supplier and then sell back to the customer. Okay, so that is the inventory turnover. If the inventory turnover is higher, it means that the company is doing better. Okay, if compared with other company that have low inventory turnover. Okay, contoh kalau ada satu company tu dia jual barang ataupun jual baju. So kalau kita nak the customer will wait for the clothes or the product from the company because of they want to restock back the clothes. Terlalu what we call in Malay laris. Jualan dia sangat laris, so that the company will have the high inventory turnover. That is better for the company. Okay. So the second one is the receivable turnover. Receivable turnover. How can we calculate the receivable turnover? Is the total revenue divided with the average receivable. Okay. How many times? Okay, receivable turnover is to look at the how many times accounts receivable are created and collected during the period. That is the receivable turnover. Account receivable is our asset. Okay, you should know that account receivable is our asset. Okay, account receivable is the person that owed you some amount. Okay. So next, the third one, total asset turnover. Okay. So total asset turnover, you have the total revenue or sales divided with the average total asset. Okay, average total asset. So what is the total asset turnover? Is the extent to which the total asset create revenues during the period. Here we can assess, okay, how much as sales that the company can generate by having that amount of asset. Okay, how much is the revenues that can the company create from the asset? So that is the total asset turnover. Okay, the fourth one is working capital turnover. Okay, what is the working capital turnover? Is the efficiency of putting working capital to work. Okay, so that how can we calculate it? You should have a total revenue Okay, divided with the average working capital. Okay, that is the activity ratio. Okay, and then let's look at the operating cycle components. Okay, operating cycle components. Can someone please read this slides? Vishal or Rishi, please read. My energy is getting low. Okay, please read this. Okay. How can you understand on that statements? Can you elaborate on your own words? What is the operating cycle components about? Vishal? Mm-hmm. 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 Okay, that is the correct one. Okay, so that is the liquidity, whether the company has much money to operate their business. Okay, and then how uh, the company policies in order to get the cash from the account receivable. Okay, that is the operating cycle components. They have two things here, that is inventory and also account receivable. Okay, so number of days of inventory is okay when the length of the buy inventory on credit is and the pay account payable, so that we will get the number of days of payables, and then from the numbers of day receivable. Okay, we start from the sell inventory on credit, and then how many days that we can collect back the account receivable. So so that the number of day of receivable is the net operating cycle. So and then both the number of days of payables and then the net operating cycle will derive on the operating cycle itself. Okay, so what is the formula? Okay, so we have three types of ratio that we need to calculate. For the first one is the number of days of inventory. Okay, it means that how many days that the company will sell their stock. Okay, start from when they buy the stock and then or the inventory, and then until the day that the company sold the inventory to the customer. Okay, so inventory, we should have the amount of inventory or the stock. Okay, goods. Okay, the goods itself. Okay, divided with the average days cost of goods sold, so that you will get the Okay, you must time with the 365 days here. Okay, times with inventory divided with average days cost of goods sold times with 365 days. So that you will get the inventory. Oh, no. Okay. How to calculate for the number of days of inventory is whether you use 365 divided with the inventory turnover, or inventory you will either divide with the average days cost of goods sold. Okay, so the interpretation is the average time it takes to create and sell inventories. Okay, that is the first one. Okay, so the second one, so if the numbers of days of inventory is higher, it means that the company will not uh, so that the company dia tak berjaya nak menjual barang dia, produk dia dalam masa yang singkat. So kurang laku barang dia. So itu maksudnya number of days of inventory. Okay, let's look at the number 2 is number of days of receivable. Okay, average time it takes to collect on account receivable. Okay, so how to calculate? Receivables divided with the average days revenue, or you will calculate using the 365 days divided with the receivable turnover. Okay, number third is to calculate the number of days of payable. Okay, payable is our account payable or creditor. Okay, so you must have account payable amount divided with the average days purchases, and or 365 days divided with the account payable turnover. That is the average time, okay, it takes to pay supplier. Okay, how many days that we take the time to pay the suppliers. Okay, because the creditors or account payable is someone, okay, or the outsiders that the company owed money to them. Okay, but for account receivable is the when the company, okay, when the outsider, okay, for example customer put money to company. Okay, that is the two different things. Alright, account receivable and also account payable. So next, what is the formula for the operating cycle? Okay, operating cycle is equal to number of days of inventory plus with the number of days of receivable. Okay, so that we will get the time from investment in inventory to collection of and then how to calculate for the network operating cycle. Number of days payable is equal to number of days of inventory plus with the number of days of receivable. Okay. No. Net operating cycle. Okay. So the formula here, net operating cycle is equal to number of inventory, number of days of inventory times with number of days of receivable minus with number of days of payable here. Okay. Number of days of payable. So you will get the net operating cycle. So what is the net operating cycle actually? Okay, net operating cycle is the time from investment in inventory, okay, to collection of account considering the use of trade creditors means that we buy, okay, we purchase the goods, okay, on credit. On credit means that we owe to the supplier. Okay, so that is a net operating cycle. Okay, so let's look at the liquidity. Liquidity is the ability to satisfy the company's short-term obligations using assets that can be most readily converted into cash. So this is the liquidity ratio. So I mentioned before in chapter 4. Okay, this is the equation for the current liquidity. So current ratio, how to calculate for the current ratio is equal to current asset divided with the current liability. So that we can know the ability of the company to satisfy current liabilities using current asset. It means that how much is your current asset? Okay, how much is your current asset of the company that the company has in order to pay the current liability? Okay, that is the current ratio. Okay, the second one is the quick ratio. Okay, quick ratio is quite different with the current ratio. Okay, so how to calculate for the quick ratio is we just use the current asset that is more liquid. Okay, we do not make the inventory and also accounts inventory and also accrual and prepayment. Okay, no need to add on. Okay, no need to add on for to calculate for the quick ratio. Okay, if you want to know when we calculate for the current ratio, the current asset include all cash, short-term investment, receivable, okay, and then inventory, and then another one is prepayment, accrued and prepayment. Okay, and then so under the quick ratio formula, we do not need the inventory and also prepayment, so that we must exclude that two items to calculate for the quick ratio. So only we add on the cash, okay, that is more liquid, okay, and then short-term investment, that also is receivable. We must just add on with these three items only as our current asset and then divide it with the current liability. So that we will get the quick ratio. Okay, so ability, okay, the interpretation of the quick ratio is the ability of the company to satisfy current liability, okay, using the most liquid of current asset. Okay, the most liquid current asset is just cash, short-term investment, and also account receivable. Other than that, it is less liquid. Alright. Okay, last is the cash ratio. Okay, how about the cash ratio? The cash ratio is equal to cash plus the short-term investment. Cash ratio more, so we exclude the receivable. Okay, so we just add on the cash and also short-term investment divided with the current liability. So we will look at the ability by using the cash ratio. Okay, ability of the company whether can satisfy the current liabilities really on the cash and cash equivalent. Okay, short-term investment is the cash equivalent. Okay. So that is the liquidity ratio. Okay, how many slides left? Solvency, profitability, there is a lot. Okay, another two, profitability and solvency, we will discuss on the next week class. Is that okay? Alright. Alright. So thank you so much for today. So later on I will give you some of the tutorials for this statement of cash flow and also financial statement analysis. Okay. So you just wait until I give you the tutorial. Alright. Thank you so much everyone. Thank you for joining me today. Welcome. Bye bye. Please pray for me on my booster day.